Today, silver has moved past 48.50 an ounce, with gold approaching $4,000 in one of the more volatile weeks for precious metals in the last decade. The operative question for any rational investor is whether this represents a speculative peak or beginning of a more sustained, fundamentally driven advance. If you're an investor or a saver in precious metals, it is essential to understand the forces that are propelling this recent price action. Concurrently, an interesting, if anecdotal, story has emerged regarding a reported recovery of over $1 million in gold from an historic shipwreck. We will analyze the recent market events and discuss the critical price levels one must consider before the Federal Reserve's next policy announcement. Let's begin the discussion. I am Turbo, and this is Turbo Stacking, where we stack with purpose. Let's roll. Let's begin with silver, which has experienced a significant repricing. This was not a gradual appreciation, but rather a sharp move higher. The week began with silver trading near $44. By Thursday, it had reached as high as $47.80, and today it reached $48.81. This represents a substantial increase in a very short period of time. It is important to note that this rally appears to be underpinned by tangible demand. The industrial uses for silver are growing, particularly from sectors undergoing significant technological change. Consider the expansion in artificial intelligence. Firms like Microsoft are constructing enormous data centers, each of which requires a non-trivial amount of silver for its components. Simultaneously, you have the transition to so-called green energy. Companies such as Tesla are not merely producing automobiles, they are building out a vast solar energy infrastructure. Both AI servers and photovoltaic panels require silver for its superior conductivity, and this demand is becoming increasingly inelastic. From a performance perspective, silver is now up approximately 49% year over year, a figure that has outpaced even the strong performance of gold. This brings us to gold. The monetary metal has been challenging what many considered to be a formidable band of price resistance. Analysts were focused on the $3,876 to $3,896 range, and gold traded firmly around $3,877 as of Friday's close, and currently at $3,964 today. This move was accompanied by substantial trading volume, which suggests that larger institutional capital is participating in this market. The rally in gold was further supported by softening U.S. jobs data and a decline in Treasury yields, reinforcing the market's anticipation of a more accommodative monetary policy from the Federal Reserve. Now, this is a part of the narrative that I find particularly compelling: the mining equities. The share prices of mining companies have seen extraordinary gains. While one must be cautious with the initial reports, major producers like Newmont and Barrick Gold have experienced significant capital inflows. From a historical perspective, when the mining equities begin to dramatically outperform the metals themselves, it has often served as a leading indicator. It's the market's way of signaling that the informed capital is positioning for the possibility of a much higher commodity price in the future. What is the primary catalyst for this activity? The next Federal Open Market Committee meeting is scheduled for October 28th and 29th, and it is positioned to be a highly consequential event. As it stands, the futures market is implying a probability of nearly 90% for a 25 basis point interest rate reduction. Lower nominal interest rates reduce the opportunity costs of holding non-yielding assets like gold. They also tend to exert downward pressure on the US dollar, which has historically inverse correlation to the gold price. Amidst this financial context, a curious story has surfaced that adds a certain romance to the discussion. There are unconfirmed reports of salvagers recovering over $1 million in gold from a historic shipwreck off the U.S. East Coast. To be perfectly clear, this is a human interest story, not a market-moving event, and it has not been broadly substantiated. So the quantity of gold is very small in the context of the global market. However, such tales capture the public's imagination and serve as a potent reminder of the timeless allure and tangible value of physical gold. So, That is the week in review. Silver advancing by nearly $4, gold testing important resistance, mining equities showing significant outperformance, the Federal Reserve poised to cut rates, and tales of treasure from the sea. Now, let's examine the charts for a technical perspective on where prices might be headed. Now that we understand the fundamental narrative, let's look at the price charts to see how the market is structured. This is where we can attempt to separate the fundamental signal from speculative noise. First, silver. The chart illustrates that a significant overhead resistance level is being challenged. For years, silver has faced a psychological barrier between $49 and $50, $49.50 and $50 an ounce. The price level has been tested on numerous occasions, but what makes the current attempt compelling from a technical standpoint is the volume. We are observing trading volumes at triple the normal levels, a strong indication that this is not merely retail speculation, but institutional participation. On the downside, silver has established a formidable support base in the $38 to $40 range, which has held on multiple tests and seems to have provided buyers with a degree of confidence. Turning to gold. With its recent move towards $4,000, the next logical area of interest for technicians would be the $4,040 to $4,200 zone. What is perhaps more constructive from a bullish viewpoint is a pattern that is formed on the weekly chart, large cup and handle formation. For students of technical analysis, this is considered one of the more reliable bullish continuation patterns. A confirmed breakout from this pattern could imply a measured move of 15 to 20%, which would yield a theoretical price objective of $4,500 to $4,600 per ounce. The primary support level is now established, far lower, which is around $3,300, which illustrates the strength of this new leg of the bull market. Key momentum indicators such as the RSI and MACD are at their most bullish readings since 2021, with both metals trading well above their 200-day moving averages on strong expanded volume. That's the important part. Before we look ahead, I want to give a huge thank you to our Turbo Stacking members, Trevor McAfee and Chris in Virginia. Your support is what powers this channel and lets us do this kind of deep dive analysis. For those of you who are not members yet, in a market moving this fast, having an edge is everything. Our members get access to exclusive content, dealer pricing on custom rounds and bars, and first dibs on our new online store launching in mid-October. That inside track could make all the difference in a market this explosive. If you want to stack with us and get that edge, just hit the join button below. What are the implications for the week ahead? Let's discuss the critical levels that warrant attention. For silver, the narrative is centered on the $50 price point. A weekly close above $50 an ounce, confirmed by high volume, would represent a significant psychological victory for the bulls. Such an event could attract a new wave of speculative capital, potentially propelling silver towards the target of $55 to $60 an ounce. Should the price be rejected at $50, a healthy consolidation back to the support zone around $42 to $43 would be a reasonable expectation. Take note of that. For gold, trading in the $3,900 range, it places it in close proximity to the psychologically important $4,000 level. A sustained breach of $4,000 would likely attract a new cohort of institutional and central bank buyers. It's worth noting that the central bank purchasing has already been occurring at a record pace, which has established a firm floor under the price. The Federal Reserve meeting is the most significant known variable. The likely scenarios are as follows. A 25 basis point cut is largely priced right now by the market. Therefore, we could witness a classic buy the rumor, sell the news reaction where prices dip modestly before resuming their ascent. Now, a surprise 50 basis point cut would signal that the Fed has deeper concerns about the economy. a scenario in which precious metals would likely rally immediately. Conversely, if there is no rate cut, it would be a substantial surprise. This would likely precipitate a sharp short term sell off, though it might merely set the stage for a more pronounced rally later on. You also need to monitor the US dollar index, or the Dixie, DXY. It is currently situated at a critical support level. Break below the 101 mark could send the dollar lower towards 98 or even 95. This would act as significant accelerant for gold and silver prices. And we must not forget the demand side of the equation. As discussed, AI and green energy are propelling industrial silver demand. Furthermore, we are entering the Indian festival season, Diwali, and the subsequent wedding season, which is traditionally a period of very strong physical gold and silver demand in one of the world's most important and populous markets. Finally, there is the matter of supply. We are beginning to see anecdotal evidence of tightening in the physical market, including potential delays from the U.S. Mint for Silver Eagles and some major dealers reporting extended delivery times. When constrained supplies intersects with accelerating demand, it's a classic precondition for higher prices. So, how might a prudent speculator or saver approach this environment? In circumstances like these, possession of the physical metal itself becomes paramount. Should this price breakout continue, the premiums on popular coins and bars could increase substantially as the supply chain struggles to meet the demand. The large capital inflows into major ETFs like SLV and GLD are also tightening the available supply of metal for delivery, creating a reinforcing self for new savers. My suggestion is to consider constitutional silver, that is, pre 1965 US dimes, quarters, and half dollars. For more experienced stackers, silver and gold eagles tend to maintain their premium liquidity in periods of high volatility. For those with an appetite for greater risk and reward, a small allocation, perhaps 10% of one's precious metals portfolio, to high quality mining stocks could provide substantial leverage to the metal price. In summary, we are at a significant juncture. Silver is testing the important $50 level. Gold is approaching $4,000. The Federal Reserve appears to be on the cusp of an easing cycle. The physical supply chain is showing signs of strain, and the romance of gold is even making headlines with tales of sunken treasure. The technical picture is constructive, the supply and demand fundamentals are robust, and the timing relative to the upcoming Fed meeting is particularly interesting. I am interested to hear your thesis. What price levels are you monitoring? How have you positioned your own portfolio for the possibilities that lie ahead? Share them with us. We would like to know. If this analysis has provided you with some clarity during this volatile week, I would really appreciate it if you would click that little like button right there and then subscribe right there, so you do not miss our analysis of the Fed's decision. Until then, do your own homework and proceed with prudence. God bless. As you were, stack with purpose, turbo out.